Stop what you are doing for just a moment, because if you receive a Social Security payment, the next few minutes are going to be worth more to you than almost anything else you will watch today. There are 3 separate rule changes affecting seniors right now in July 2026, and every single one of them is already active. Not proposed, not on the way, already active. One of them can make your monthly deposit vanish if you do not take action before a switch gets flipped. One of them can put $12,000 back into a married couple's pocket at tax time, and almost nobody is claiming the full amount because they are completing the paperwork incorrectly. And one of them places a firm legal ceiling on what you will ever pay for your prescriptions within a calendar year. A ceiling that did not exist even 2 years ago. I am not going to hand you headlines today. Headlines do not deposit money into your account. The specific form does. The specific phone number does. The specific box you check on your tax return does. So that is what today is about. 3 changes, 3 precise moves, nothing extra. This channel breaks down government benefit updates using publicly available information. Before we begin, if this channel is helpful to you, hit subscribe right now because I release one of these detailed breakdowns every single day. And the whole purpose only works if the right people actually see it before the deadline arrives, not after it has passed. Here is exactly where we are headed, so you can jump directly to whatever matters most to you, though I would encourage you to sit through all 3 because the one you assume has nothing to do with you is usually the one that does. Change 1, your Social Security delivery method. If you are still receiving paper, this is the one with a countdown attached to it. Change 2, a federal tax deduction worth up to $6,000 per person and $12,000 for a couple that most tax preparers still do not ask about correctly. Change 3, a firm dollar cap on what you pay for Part D prescriptions in 2026 and the no-cost program that can push your expenses towards 0 even faster. Your deposit, your refund, your prescriptions. Let us go through them in order. A quick and honest answer before we dig in, because you are probably already wondering. These changes do not arrive with a letter that reads, "Pay attention, this is important." They show up as a line inside a Federal Register notice, a press release time-stamped on a government website that nobody visits, or a threshold buried on page 40 of a benefits guide. Nobody is assigned to telephone you and confirm you claimed your deduction. The system simply assumes you will find it on your own. When you do not, the money just stays where it is. That is not a conspiracy. It is just how large bureaucratic systems operate. The solution has always been the same, learning about it before the deadline rather than after it. Here is where we begin because this particular change has the shortest fuse of the 3. Executive Order 14,247, signed in March 2025, directed federal agencies to stop sending paper checks and transition everyone to electronic payment. September 30th, 2025 was the original cutoff date. The Social Security Administration has confirmed it is now completing that transition throughout the remainder of 2026. Meaning, if you are among the small number of people still receiving a mailed check, the time remaining is shorter than it was 6 months ago, not longer. Who does this affect? If your benefit already arrives via direct deposit, you can relax. Nothing about this situation changes for you. If you are still on paper, here is the part that deserves your full attention. Paper checks are significantly more likely to be lost, altered, or stolen from a mailbox than an electronic deposit ever could be. This is not the government creating unnecessary difficulty. It is the government closing the precise door that criminals use to steal a widow's rent money straight out of a mailbox in the middle of the afternoon. I have personally watched a client spend 6 weeks proving to a bank that a stolen and forged check was not hers to cover, while her actual bills continued arriving without pause. Electronic payment eliminates that specific nightmare entirely. Your 2 options explained in simple terms. Option 1, direct deposit. The money lands directly into your checking or savings account. Set it up through your bank, online through your My Social Security account at ssa.gov, or by calling Social Security at 1-800-77-21213. Your bank can also assist you as they handle this regularly, and enrollment takes only minutes. Option 2, the Direct Express card, a prepaid debit card the government loads automatically each month, built specifically for people who do not have a traditional bank account. No bank required, no credit check, no minimum balance necessary. To enroll in Direct Express or review your electronic payment options, visit godirect.gov or call the number provided. If your circumstances are genuinely extreme, meaning no banking access whatsoever or another documented hardship, you may request a waiver through 1-877-874-6347. But I want to be straightforward with you. That waiver exists for rare situations, not as a way to hold on to a paper check simply out of habit. The one thing you absolutely should not do is wait and hope the check keeps arriving. This is not a warning intended to frighten you. It is simply the reality. The paper option is closing, and the sensible move is switching over on a calm afternoon, not scrambling after a payment has already gone missing. That first change protects money you are already owed. This next one is different. It is about money the IRS is currently holding for you that you may have never heard exists. Tucked inside the 2025 tax legislation, the one you have likely heard referred to as the One Big Beautiful Bill, is a brand new deduction designed specifically for people 65 and older. It is called the Enhanced Deduction for Seniors, and it is worth up to $6,000 per qualifying individual, or $12,000 for a married couple when both spouses are 65 or older. Here's the sentence I genuinely want you to absorb. This sits on top of your regular standard deduction and on top of the additional standard deduction that people 65 and older already received. You are not choosing between them. You stack all of them together. Real numbers follow, so this does not remain abstract. Picture a married couple, both 66 years old, living on Social Security and a modest pension, combined income well beneath the limit. Both qualify. That is $26,000 in total deductions, meaning $12,000 of income the IRS simply never touches. Depending on their bracket, that frequently means over $1,000 returned to their pocket, sometimes approaching $1,500, the difference between owing the IRS and owing nothing at all. Now picture a single retiree, 70 years old, with modest retirement account withdrawals, comfortably beneath the limit. She receives the full $6,000. No itemizing required, no receipts, no accountant needed. Here's what makes this genuinely accessible. This is an above-the-line deduction. You do not need to itemize to claim it. You take your standard deduction exactly the way you always have, and this stacks right on top of it through Schedule 1, a form the IRS created specifically for this provision. The income cutoff, and this is where people frequently go wrong. The full $6,000 or $12,000 combined is available if your modified adjusted gross income falls under $75,000 for single filers or $150,000 for those married filing jointly. Above that, it does not disappear all at once. It phases out at 6 cents for every dollar over the threshold and is fully eliminated once you reach $175,000 as a single filer or $250,000 filing jointly. That phase-out calculation matters because the income counted here is not limited to your Social Security. It includes IRA and 401k withdrawals, interest, dividends, capital gains, everything appearing on your return. One substantial IRA withdrawal or a large Roth conversion in a single year can quietly push you over the threshold and shrink a deduction you were depending on. If you are near that limit, spreading a large withdrawal across 2 tax years instead of taking it all in December can be the deciding factor between the full $6,000 and a reduced one. One filing status note. If you are married, you must generally file jointly in order to claim this. File separately and you are excluded. No exceptions apply. Your action, if filing your own return, is to ensure your tax software has your correct birth date entered. Most programs will apply it automatically on Schedule 1, but only if you do not skip past the age question. If using a preparer, say these words directly. I am 65 or older. Please make sure you are applying the Enhanced Senior Deduction on Schedule 1. I would rather you sound repetitive than leave money sitting on the table. Already filed and believe you missed it? This deduction applies to tax years 20, 25, through 2028. You can go back and file Form 1040-X to amend a return you have already submitted. That is real money the IRS will send you for a year that has already closed. The only requirement is completing the form. Your deposit is protected. Your refund is larger. Now let us discuss the one that carries the most weight if you are managing a serious health condition, because this is the one that used to have no ceiling whatsoever. For years, the most painful aspect of Medicare Part D was this. If your medication was expensive, there was no genuine stopping point. A serious diagnosis could mean paying and paying year after year for as long as you needed the drug. That is no longer the case. Because of the Inflation Reduction Act's redesign of Part D, there is now a firm annual out-of-pocket cap on covered prescription drugs. It stood at $2,000 in 2025. For 2026, adjusted for inflation, that cap sits at $2,100. What this means in straightforward terms is that once your out-of-pocket spending on covered Part D drugs reaches $2,100 this year, you are finished paying. Your plan covers 100% of your covered medication costs for the remainder of the calendar year. Not a reduced portion, all of it. What counts toward that $2,100 and what does not? What counts includes your deductible, capped at a maximum of $615 in 2026, your copays, your coinsurance, and every dollar you actually hand to the pharmacy for a covered drug. What does not count is your monthly premium, which continues regardless. If you take a specialty medication running several $100s per refill, you could reach that $2,100 ceiling as early as spring. And from that point through December, every covered prescription costs you nothing at the counter. There is also a Medicare prescription payment plan now available, which allows you to spread that $2,100 across monthly installments throughout the year. Rather than paying it all up front, this option is worth asking your plan about if a large bill early in the year would put a strain on your budget. The action that multiplies this benefit is applying for extra help. If your income is limited, there is a federal program administered through Social Security called Extra Help, also known as the Low Income Subsidy, that can reduce your Part D premium, deductible, and copays on top of the $2,100 cap. A significant number of eligible seniors never apply because they assume their income is too high. Do not make that assumption. The income and asset limits are more generous than most people expect, and the only reliable way to know for certain is to apply and allow Social Security to evaluate your actual numbers. Apply online at ssa.gov or by calling Social Security directly using Form SSA-1020. It costs nothing to apply, and if you qualify, it can stack directly on top of the $2,100 cap to make your medications close to free. Let us bring everything together so none of this fades the moment this video ends. Change 1, paper Social Security checks are being phased out right now. If you or someone you love still receives one, switch to direct deposit or the Direct Express card at godirect.gov or by calling 1-877-874-6347 before the option disappears entirely. Change 2, the $6,000 or $12,000 combined senior deduction is real. It stacks on top of your standard deduction and is claimed through Schedule 1. If you already filed and missed it, amend your return using Form 1040-X. Change 3. Your Part D covered drugs are capped at $2,100 out of pocket for 2026. If money is limited, apply for extra help through Social Security. It is free to check and it stacks directly on top of the cap. Your deposit, your refund, your prescriptions. All 3 are available right now, waiting for the people who take the next step, rather than the ones who simply nod along and move on. One important note before you go. This is general education, not legal, tax, or financial advice tailored to your personal situation. Please confirm your specific numbers with Social Security, the IRS, or a licensed advisor before acting on any of it. But do not allow that to stop you from picking up the phone today. If this helped you in any way, share it with one person over 65. There is a genuine chance nobody has walked them through any of this yet. And subscribe, because I break one of these down every single week. The entire purpose is making sure you hear about it before the deadline arrives, not after it has already passed.